So we are back for another video, and this month is Annuity Awareness Month. So we're going to be talking about what annuities are, how they work, and things that you should know and understand about different types of annuities. So let's dive into it and talk about how you can achieve guaranteed lifetime income in retirement. So you may or may not be familiar with an annuity, but it actually is not a new concept. The concept actually dates back to the Roman Empire, and during the reign of emperors, it actually signified a contract that would provide annual payments over the course of time. And in the beginning, in the early days of the US, deferred payments were actually used to help develop the US government. Also, the founding father, Benjamin Franklin, actually bequeathed sums of money to the city of Boston and the city of Philadelphia using deferred payments that were paid out after his passing. As a prudent thinker, Benjamin Franklin understood the logic and the benefits of payments being spread over the course of time and established this forward-thinking strategy. Another great way to think about annuities is actually through pensions or Social Security. So pensions aren't something you probably will hear about much nowadays, but if you worked for a company many years ago, how a pension worked is that you would work for a company for, let's say, 25 years. And during those 25 years, you would contribute to your pension, or also known as a defined benefit plan. And then after that point, when you retire, you would receive consistent monthly payments from that time on for the rest of your life. Social Security also is similar to an annuity as well too. So if you earn active income, you're going to be paying Social Security taxes. Everyone pays them, they just come out of your paycheck and you don't really have a choice at the end of the day. But how that works is essentially you pay Social Security taxes, and as long as you work for at least 10 years, you are going to receive Social Security. And Social Security is going to be made up of 35 of your highest earning working years. So when you retire, you can start receiving Social Security payments at age 62, or you can defer up to age 70 for a maximum benefit. But once you start Social Security, it essentially starts then and then will last for the rest of your life. So nowadays, when you hear the word annuity, it typically refers to a paper asset or contract. Annuities are issued by insurance companies, and it's kind of like creating your own pension. So for annuities, there are not immediate annuities. They're generally going to have two different phases, the accumulation phase and the annuitization phase. So during the accumulation phase, that's when you're going to be contributing to an annuity and the account is essentially going to be growing. And then you go towards the annuitization phase, and once you annuitize that contract, that's when you start receiving payments, typically on a monthly basis, specified by the contract that you have. So annuities can also come with different options depending on what your situation is and what would best fit you at the end of the day. And those options are going to be referred to as riders. Some of those riders can include death benefit protection. So for example, if you pass away during the annuitization period, then a death benefit will be paid to your beneficiaries on the contract. They also can include things like inflation protection, so the payments that you receive are going to continue to increase based off inflation. They may also have things like survivorship benefits for your spouse. So for example, if you pass away, that stream of income is going to shift to your spouse for as long as they're living as well too. Other benefits that they can have are things like disability income benefits, so they may have increased payments if you experience a disability, or long-term care benefits. So if you were to experience a long-term care event, you could actually use that annuity contract to help pay for long-term care expenses, generally in a tax-advantaged way. So when you're setting up an annuity, that's when you'll go through and pick what type of contract you want and different types of riders or options on the policy. So during the funding period, you could either fund that contract with a lump sum, or you could fund it over the course of time with just periodic contributions. And then after the funding period, you'd receive payments either immediately, or you'd specify some date in the future at which you want to receive payments. And those payments could last for a guaranteed 10 years, a guaranteed 20 years, or guaranteed for the rest of your life. So similar to a 401k, The money in the annuity is going to grow tax deferred. But also like a 401k, you're not going to have access to those gains in that account without a penalty until 59 and a half. So it's important to understand that once you make those contributions, those funds are all going to be relatively illiquid. Unlike a 401k though, you're not going to receive tax deductions on money that you put into an annuity. But you also aren't limited on how much you can contribute. So there aren't those same limitations on a 401k, so you really can contribute. And this is specifically with a non-qualified annuity as much as you want or need to. So annuities are very unique. They're the only financial product that can provide guaranteed lifetime income and help you maintain the lifestyle you've earned. So that way you don't have to go get a job at Walmart greeting people because you're running out of money. They can be very helpful for people that also like to understand exactly how much money they're going to be spending every single month. And it can help protect against some risks in retirement, like if there are bad returns in the market, otherwise known as sequence of returns risks, which can cause your portfolio to run out of money faster than expected. So annuities come in a lot of different flavors and a lot of different sizes. Depending on the company you're going with, you're going to have different options available to you. And unfortunately, this often leads to people being more confused about what is really best for them. If you guys are familiar with the overchoice paradox or choice overload, this is essentially when you have a lot of different options available to you, and it actually can be detrimental to the decision-making process. If you think about it, like let's say you go to an ice cream shop and you have 100 flavors, all in front of you. One, it's going to take you a lot longer if you do actually choose, which flavor is the one that you want to go with. And then you're probably going to be a little bit dissatisfied because you have that comparison bias when you actually do end up picking what you want. So this is one of the reasons why I do recommend working with an advisor, so that they can help you figure out what is going to be the best option for you at the end of the day. But I'm going to break down some of the common types of annuities that you're going to see out there so you guys can be more aware as to what different options are usually available. So the first is a fixed annuity. A fixed annuity is generally going to have a fixed rate of return, and that's usually correlated to market interest rates. So if you're in a good interest rate environment and interest rates are particularly low, the returns on the fixed annuity are also going to be relatively low. But if you're in a bad interest rate environment and interest rates are high, that return is actually going to be a little bit higher. So that's something to keep in mind. Then you also have variable annuities. Variable annuities are going to be exposed to the market. So they have sub-accounts that the money or premiums that you're paying into the annuity contract are invested into. So you're going to have direct exposure into the market. So you're going to have a higher potential for appreciation and gain in the account, but you also have a higher risk for loss as well too. So you're taking a little bit more risk, but you also have more potential for growth as well too. Then you also have index annuities. Index annuities are kind of going to be between fixed and variable. Essentially, your money in the annuity is tied to an index. So with that, you're going to be a little bit safer, again, than variable, but a little bit more risky than fixed. So typically, they're going to have like a guaranteed rate of return, like a floor on the annuity, and they're also going to generally have like a maximum, which would be like a cap on your returns, because again, it's tied to an index that is correlated to the market. In addition to those, you also have immediate annuities. An immediate annuity is generally funded with like a lump sum, and that annuity can be started as soon as a month after you've finished all of your paperwork with getting the contract put in place. Then you also have deferred annuities. Deferred annuities can also be funded with a lump sum, or they can be funded with a series of payments over time, and then you would specify when you actually want that annuity to start paying out. And during the time before it actually starts paying out, that money in that contract is going to grow tax deferred. Then you also have non-qualified annuities. Non-qualified annuities are going to not have any types of tax deductions for contributions that are made into the annuity, but they're also not going to have any contribution limits, as I've mentioned before. Then you also have qualified annuities. Qualified annuities are typically going to be funded through contributions into like a company-sponsored plan, like a 401k. A very common form of a qualified annuity that you'll see out there is a TIAA, which stands for Teachers Insurance Annuity Association. So that's pretty common for teachers out there. Essentially, with a qualified annuity, again, you're going to be funding it through contributions into that plan. You are going to have contribution limits with that qualified annuity, but your money that you put in that plan is actually going to be tax deductible on your current income as well too. So they can be beneficial from that standpoint. So annuities can be great financial tools because they can offer a worry-free stream of guaranteed income. And some annuities are going to offer dividends, but it's important to know that those dividends are generally not going to be guaranteed. But annuities inherently are going to be very flexible because they do offer a lot of different ways to customize that contract as you're getting it set up. Annuities are also generally going to be looked at as illiquid. During the accumulation phase, you may have access to the capital that you've used to fund the contract with, but it's important to know that you're usually going to be accessing that money gains first. And if you're accessing it before 59.5, you're also going to be stacking on top of that a 10% early withdrawal penalty that the IRS implements because that money is growing tax deferred. Then during the annuitization phase, in most cases, unless you have special options or riders on there, you're only going to be receiving the payments, on a periodic monthly basis. So again, you won't have access to that money, especially in the annuitization phase. So annuities can be great. Again, you just want to make sure that you're planning out, when you'll actually be utilizing the income. And not everyone needs an annuity. If you have a pension and Social Security, those can provide what you need from a guaranteed income standpoint for your retirement needs. But if you don't have a pension, annuities can be a great tool to help make sure that you're essentially creating your own pension so you have some guaranteed lifetime income for the long run. So important things to consider when it comes to annuities, just like with any other asset, are things like expenses, risks, and then your overall objective. Again, I highly recommend making sure that you're really intentional if you're planning or working with an advisor that can make sure that whatever you're getting is going to be aligned with your goals in the long run. So I hope this video is helpful, and if you guys liked it, please like, comment, or share this video with someone else who you think could benefit. And if you guys have any questions, feel free to reach out.